Hello, I'm Tim Craighead, Senior European Equity Strategist for Bloomberg Intelligence, and I'd like to share a few of our thoughts about the FTSE 100's outlook for the second half of this year. Overall, we believe that the FTSE's surprising status as 2022's safe haven among major global markets looks set to continue. Let me offer 5 points to consider. First, the FTSE 100 has significantly outperformed in the first half of 22, beating the Stock 600, for example, by almost 20 percentage points since January. It's done this by treading water in the midst of a virtual whirlpool of issues and concerns. Now, how has it accomplished this? Point 2, it's all about the very unique composition of the FTSE. As you can see in this breakdown of earnings by sector, more than 80% of the market's EPS comes from energy and materials, financials, and globally oriented staples and pharma. With this in mind, oil and metals prices, rising interest rates, and a falling currency are all positive catalysts, where they are negative for most other markets. This fundamental positioning is what's key to us with the FTSE. Now, the third point, valuation. It is also very low, but we take this supposed asset with a bit of a grain of salt. Yes, at less than 10 times forward earnings, it's undeniably one of the cheapest major markets globally, and it trades at a notable discount to its 15-year average versus Europe and the US. But much of this is also driven by that unique composition that we mentioned before. It's big in low multiple industries, think tobacco, banks, integrated oils, miners, and it's very small in high valuation groups, with next to nothing in the index for technology, internet, and e-commerce. Also, it's very hard to argue for a revaluation if interest rates continue to rise in coming months. This correlation analysis shows the clear inverse relationship between the UK market's PE and the 10-year gilt yield. Now, beyond thinking about the FTSE versus Europe and the US and other major markets, we also see opportunities within the FTSE to amplify exposure to some of its key drivers. A weakening domestic economic and political situation is clearly hurting sterling. And all of this, in turn, makes UK domestic stocks suffer versus internationally oriented peers. We see this continuing. B, similarly, smaller cap UK companies tend to be more domestically focused, playing into the same argument for underperforming larger cap peers. And C, lastly, growth stocks are suffering versus value and dividend yield oriented groups. Much of this relates to duration analysis, which suggests this trend may continue as long as rising rates continue. Now, fifth point, lastly, what are we worried about? Profit margins. Like other markets, the FTSE's operating margins are projected to rise into 2023 to record levels. Some of this is driven by energy and materials' rapid rise on higher commodity prices, but margins are also expected to expand for the rest of the market, even with inflating costs and slowing economic indicators. We fear mid-year results could be fraught with disappointments and negative revisions. But, number one, the FTSE's composition, as we've discussed, offers relative protection versus other markets. And secondly, its lower valuation already discounts some earnings downgrades. So let me bring things to a close here. This short summary is only the tip of the iceberg. You'll find much more detail on the FTSE and other European markets at our European Equity Strategy dashboard, BI Stocks E. Please don't hesitate to reach out via email or Instant Bloomberg. We look forward to connecting.